What is PE ratio? Hello everyone and welcome to mangomonkey Learns Money. In my channel, I want to give you guys ideas on how to become a millionaire. And I truly believe that this can be done if you can invest only $100 per week and have the patience to wait up to 55 years. So I upload daily videos around saving money and making money to help you get that extra $100 to invest. And I also talk about how I invest my money in my channel. If you invest your money and earn a measly 4% per annum rate of return, you will need 55 years to become a millionaire. But the smarter you can invest, the higher your rate of return, and the faster you can reach that coveted millionaire status. In today's video, I will briefly introduce you to the concept of PE ratio when it comes to analyzing the value of a particular company, a particular stock, or a particular share. PE ratio stands for price to earnings ratio. This is the price of the stock on the market divided by the annual earnings or the annual income of the company for each stock that the company has. This ratio is sometimes also called the price multiple or the earnings multiple. A high PE ratio could mean that the company's stock is overvalued, or else that investors are expecting high growth rates in the future. Companies that have no earnings or that are losing money do not have a PE ratio because there is nothing to put in the denominator. Most PE ratios are what's called trailing PE ratio. That is, the earnings figure in the denominator is the historical earnings figure based on the most recent financial report. There is something called forward PE ratio, which uses the projected earnings rather than the historical earnings. So now I know what is a PE ratio, but what is a good number for the PE ratio? There is no definitive answer because different industries are priced differently because they have different growth potential and different risk profiles. But in the United States, the average PE ratio of the top 500 companies has fluctuated from around 6 times in 1949 to over 120 times in 2009. The long-term average PE ratio for the top 500 companies in the S&P 500 index is around 15 times, meaning that the stocks that make up the index collectively command a premium 15 times greater than their annual earnings. Another way of saying this is that you are paying 15 times of what the company earns each year. So if you cannot find another buyer to offload the stock to, it will take you 15 years to recover the money that you paid for the stock. Benjamin Graham, in his book The Intelligent Investor, published 71 years ago, mentioned that he looks for a PE ratio of 9 or less when he wants to invest in a value stock. If the PE ratio is more than 9, the company may still be a great and wonderful investment, but it would need to grow quickly instead of making the same amount of earnings every year. If you would like to learn more about PE ratio, check out the Investopedia article I have linked in the video description on YouTube. Like and share this video if you found it useful. Thank you for watching and have a lovely day.